Good evening, everyone. Myself, C.A. Raj Chawla, Vice Chairman of MSME and Startup Committee of ICI. First of all, I
Recording in
welcome
progress.
C.A. Dr. Debashish Mitra, the President of the Institute of Chartered Accountant of India. I also welcome C.A. Aniket Sunil Talati ji, Honorable Vice President of the Institute of Chartered Accountant of India. I also welcome my Chairman, C.A. Dheeraj Khandelwal ji, Chairman of MSME and Startup Committee. I also welcome all the dignitaries. So, first of all, happy Startup Day. This Indian Startup Committee wholeheartedly welcome the government's move of celebrating January 16 as National Startup Day. We are extremely confident that the contribution from startup towards building an Atmanirbhar Bharat will get its due recognition with this initiative. With the immense future opportunity available and the number of innovators coming towards to embrace those, the times to come will be very interesting. We look forward to the major announcement for further strengthening the innovation, entrepreneurship, and startup ecosystem. National Startup Day is the right step towards the Startup India initiative that was launched by the government in 2015. With this announcement, the Indian startup ecosystem has been given a global identity, and this has opened up a new way for funding. Global investor will be attracted to Indian startup with the immense future opportunities available in the sector and the numbers of innovators coming forward to embrace those. The time to come will be very interesting. We look forward to getting more measures from the government, such as more subsidies, tax benefit, and easy bank loan for future strengthening the innovation, entrepreneurship, and startup ecosystem. All these steps will be crucial to building sustainable business in India. Wish you a very happy startup and happy learning. Thank you.
Thank you, Vice Chairman Nachawlaji. I think I'll welcome my dear President and as well as my vibrant and young dynamic Vice President Aniket Talati for this a very unique program on the startup. I can say it's thank you both of you for giving this opportunity for organizing a startup Sambad. I think after the great success of the ICI onto the MSME Yatra, our dynamic leader, both the leader, I can say it's Debashish Mitra ji and as well as Aniket Talati ji, had deemed fit. This is startup ecosystem. It's not only for the chartered accountant, it's for the entire country and for entire nation. And he chosen the right path on 16th of January, being a National Startup Day. Let's eliminate the knowledge of the startup to across the nation, across the area, across the board. Whether it's a student, whether it's an entrepreneur, whether it's a other professional, whether it's all our own fraternity people, chartered accountant. Let's know about the startup, how the India is booming in this startup. We became the unicorn hub of the startup, and in the years to come, our economy, the $5 trillion economy, even the developed nation, our Prime Minister Modi Vision 2047, going to through this startup. And the startup, it's going to be a new norms for each and everything. And I can say it's being in this year 85,000 startup, maybe in next 5 years, maybe a 500 startup, maybe a 500 unicorns going to become, and all unicorns has to be from the startup and all across the area. And where we can ICI as can be a knowledge hub, knowledge partner, knowledge dissemination partner for each and every people about the startup. And that's why the entire this Sambad, both the leadership has given this opportunity to have the various program. This in entire month, we are having a 45 branches program where the big cities where we guiding our chartered accountant as well as the student, as well as the stakeholder, as well as the entrepreneur, importance about the startup, importance about the valuation, how they can a successful startup, how they can prepare a pitch, and what is the funding going to be there, how they can create raise the fund, all sort of knowledge of the startup and ecosystem which we are giving to across the India. And I'm seeing that in last 15 days, today is the 16th day, and 16th we carried out about the 17 program across nation, and 45 program going to there, and this entire ICA Samvad going to conclude by our honorable president and vice president on 2nd of February at Mumbai. And we'll see that how the outcome going to be there. More than around 10,000 we are estimating about new entrepreneur will guided by our ICA Samvad. Maybe we become a knowledge hub, and through this area also we are becoming a partner with various colleges, various incubations, and various entire ecosystem. And thankful for my young dynamic leader Aniket Talati, as well as the Devashish Mitraji, for gazing this right opportunity in the startup, in the partner nation building. Though I say is a partner nation building, but through this startup ecosystem, they are creating a real partnership. With this, thank you very much for each and everyone to be participating in this startup ecosystem. And I have very right person, Chaurasia ji, who is going to deliver his thought about the ecosystem. Before that, I invite my Vice President, Aniket Talati, young dynamic leader, to address all our participants about this startup.
Thank you very much, Dheeraj Bhai, the very respected President of the Institute of Chartered Accountants of India, Sri Dr. Devashish Mitra ji, the Vice Chairman of this committee, Raj Chawla ji, the speakers for today, and of course one name which is synonymous with startup of Dheeraj Khandelwal ji. Let me begin that when I was in the regional council, and the first time I heard the word incubation center, startup ecosystem, was in fact when Dheeraj Bhai was in the council, and he initiated the entire startup movement. Today, yes, we are celebrating the National Startup Day, but I think it is because of leadership of Dheeraj Bhai and his vision and very clear thought process that startups are going to be the future. That I think way back 7 years ago, 6 years ago, ICI started working on the startup ecosystem. And today we have a fully dedicated committee on startups. So I begin by complimenting Dheeraj Bhai and Raj Chawla ji for the wonderful work that they are doing in the Startup Samvad programs. I am seeing all the branches, not just in my region, but across the country, the kind of enthusiasm with which the programs are being held on startup. I think the last such enthusiasm was only seen when GST was launched in 2017. And after that, today, all the branches are very eager, very actively doing programs on startup. Today is 16th of January, National Startup Day. For the 2 previous days, that is 14th and 15th Jan, we celebrated Uttarayan in Ahmedabad. And I think Uttarayan, or the kite flying festival, is also very similar to what we are doing in the startups. Not all kites will fly so high and soar above the sky. Some will get cut and may not become unicorns. But I think it is the passion with which you fly kites, similarly with the passion with which the entrepreneurial spirit in this country has been unleashed in times of people, young generations, not choosing the safe path of jobs, but going for entrepreneurship. And I think the startup ecosystem has provided this. I will only say that my first encounter of how successful this startup ecosystem in our membership is was during the iconic World Congress of Accountants, where on the second day, and mind you, this was a 4-day conference, on the second day, when the day started at 9 a.m., and we had Yoga Guru Baba Ramdev ji doing yoga, so many speakers, Mr. Gautam Adani speaking, we had the regulators coming on the second day. And at evening 7:30, when one was leaving the center, I thought all the members would have been tired and therefore would have not seen too much crowd in the hall. I went into one of the halls in the World Congress. At 7:30 p.m., Dheeraj Bhai and his entire team, along with some international delegates, was doing a startup week and a startup session on fundraising. And to my utter surprise, but extremely happy and pleased to see that the entire hall was jam-packed. People were in fact standing and attending the startup program, which was dedicated to a pitch night. And some startups were giving pitches on their ideas. And I think this itself was a testament of what kind of acknowledgement, appreciation, and acceptance the startup ecosystem has got from the chartered accountant community. not just as consultants who are incorporating startups, not just as tax practitioners who are getting them registrations of the startup, but more importantly, also as entrepreneurs who are building their own startups and are looking to fundraising and other various opportunities. I think it was said in the World Congress that if there was ever a time to be in India, to be associated with India, it is now. I think similarly, if there ever was to time to be a startup or to incubate a startup, it is now, and it is now in India. With these words, I once again compliment the committee for this wonderful program, and of course, the leadership of our Honorable President, sir, who has promoted these startups, ensure that we have enough sessions on them throughout the year, and of course, the startup Sambal, which is happening in all branches throughout the year. Compliments to you, President, sir, for your vision of promoting the startups and having this wonderful committee doing glorious work, not just in MSME, but also in the startups arena. Thank you very much.
Thank you, BP sir, Aniket Talati ji, for your word and as well as support to the startup entire ecosystem and acknowledgement on for this the World Congress startup session. Thank you very much. Now I request the visionary leader, the Honorable President of the ICI, Devashish Mehta ji, for their speech.
Thank you very much, everybody. Dheeraj Khandelwal, the Vice President of the Institute of Chartered Accountants of India, Aniket Talati, Dheeraj Khandelwal, the Chairman of MSME and Startups, the Vice Chairman, Dr. Raj Chawla, and everybody else for listening to me. First of all, you see, I would like to agree, and I usually agree with the Vice President, whatever he says, but I would like to agree with him on this, that you see, Dheeraj Khandelwal over the period of time has been, you see, synonymous with the MSME and the startup programs that the Institute of Chartered Accountants of India has organized. You know, many of you would note that, you see, he just had organized the MSME Yatra, where 75 programs in 75 cities, and it was in the Indian Book of Records, you see, the number of programs that was organized. And then when he went ahead and had this startup Samvad platform, many of us, we thought that how much success will it get? And today, as the Vice President is saying, you know, it has spread, its aroma has spread far and wide. And you see, people have just caught on with the, you see, with the concept. And you see, it is, I can see, you know, in my mobile, I can see the WhatsApp that how many programs are being held and how enthusiastic people are about this. This only talks about how the Institute of Chartered Accountants of India has been evolving. We are, you see, pushing ourselves into uncharted areas where we did not go before, and in the process succeeding, right? When Aniket Talati talks about the startup program in the World Congress, I also totally agree with him. I never thought, let me tell you like him, that at 7:30 in the evening, there were so many people attending the program. Just like he was surprised, I was also surprised. But then the whole idea has caught on, and we have just done this. 16 January, the National Startup Day, fantastic. And mind you, we are the third largest, India is the third largest in the world scenario in startups, in the startups ecosystem, right? So we are, and with over 84,000 recognized startups. And then both I, Dheeraj, and Chawla ji, Aniket, we do talk about the G20. And the G20 has also a Startup 20 engagement group. And we at the Institute of Chartered Accountants of India, we are trying our best to associate ourselves with the G20 programs to further give a fillip and push to the startup engagements. Mind you, those of us who have seen the January 2023 issue of the Chartered Accountant, you must have noted that the whole issue was dedicated to startups. The whole issue was dedicated to startups. In fact, you see, when we were developing that issue, many said that who is going to read this? Right? It's totally new. Our people, you see, you are deviating from tax and going for something new. We said that let us try it out. And so many people, they have said that it's very apt that the institute, institute has done this. So I congratulate the committee for all the good work done. And of course, as Dheeraj Khandelwal was saying, it will culminate in a program on the 2nd of February, in which all of us, we hope to be present in Mumbai. Once again, my hearty congratulations to the committee for having done such fine job. The Vice President himself has also led from the front, engaged, encouraged Dheeraj, Rajji and everybody, gave them a nudge so that, you see, we can do very well. At the Institute, it is always Team ICI. So we all get together and try to do everything together. And I'm so very happy that another new concept is, getting so much of, popularity and so much of traction. So all the very best and happy National Startup Day. Thank you very much.
Thank you, President and Vice President, both of for having built the confidence of the Team ICI and giving the concept of Team ICI rather than the other things. So thank you very much, sir. Now it's time for the speaker, Tarun Chaurasia, for their speech on the day of the MSME Day to the people. Over to the Tarun Chaurasia.
Thank you very much. I hope you all can hear me. Can you hear me? Just give me a thumbs up, please. All right. Thank you very much. And honorable members of the Institute, Dr. Debashish Mitra, President ICAI, and CA Aniket Sunil, Vice President ICAI, CA Dheeraj Kumar Khandelwal, Chairman MSME Committee, and Dr. Raj Chawla. Thank you very, very much for inviting me. And it's always a pleasure to speak at an ICAI platform. Today's topic is startup valuations. It's been always been a debate how to value startup, and today I will try to share my personal experience having worked with a well-known institutional private equity fund for close to about 10 years, 2008 till 2017, and subsequently closely interacting with a lot of startups and a lot of the community. So it's a highly educated, well qualified, enlightened audience that we have today, and people are chartered accountants. So I will try to be more practical, and I would really appreciate that if we can make it more interactive, and you can ask more and more questions, and we'll try and finish it on time. So let me just switch on to a small presentation that I have prepared, and we'll take it forward from there. Just give me a second, please. Hello. All right. So this slide is just to give you an overview and the magnitude of the industry, the venture capital industry. Sorry, I think Dr. Sambit is calling me. Just give me a second. Hello. Ji sir. Sir, I'm on the presentation. I'm on a call. Hello. Sorry, I got a call from Dr. Sambit from the Institute. I thought, let me just pick it up. So coming back to the main slide, this slide gives you an overall magnitude of the venture capital industry and the entire startup ecosystem. As you can see that year 2021 has been an exceptional year in the venture capital industry, wherein we saw an investment to a magnitude of about $38.5 billion in year 2021. However, 2022, I don't have the exact number, but there has been a reduction in the venture capital investments for obvious reasons that we are all aware of it. Look at the number of startups. We had 471 startups in 2006, which has grown to now 73,000 startups. All of these startups have been in the market in the last few years, trying to raise money from one angel investors to other venture capital investors. And each startup, when we talk about a fundraising, we are always discussing, talking, and negotiating what is the value of my company. So it's practically very difficult for all the advisors and more specifically the community of chartered accountants to actually ignore this particular subject. In terms of the number of deals, it is 2x growth in terms of the number of deals, which reached to about 1,500 plus. We have got about 100 plus unicorns, and over 900 alternate investment funds are registered with SEBI as of May 2022. Point number 6, please note, and it's very, very important, that over $9 billion have been raised by venture capital and private equity investors, which are focusing the Indian market in the previous 12 months. Now, despite of the fact that there is a reduction in the deal volume, in the deal amount in the year 2022, what's important to know that dry powder is not an issue. What is a dry powder? Dry powder is nothing but the amount of capital available with a venture capital investors to be deployed in a number of portfolio companies, right? So money has never been the issue with the industry. It's always the quality of the startups that they are struggling to figure out. The share of India's share of global VC funding almost doubled from 3% to 5.6%. And as we mentioned earlier, we had a banner year in 2022. So can we really ignore the startup ecosystem? Answer is obviously no. All right, let's quickly jump on to the valuation. Before we talk about the valuation methods, I wanted to quickly capture some of the important fundamental basic principles which is applicable irrespective of which method of valuation one may apply. Okay, so calculations are not as objective as you might think of. A lot of guesswork, and it's a tricky affair. Irrespective, the number of methods which we all have been applying, we all have been talking about, whether it's a DCF method, whether it's multiple, whether it's VC method, or you name any method that you talk about, it's always been a tricky affair. It involves a lot of judgment, a lot of forecast, a lot of estimates. It's not a simple, plain, vanilla calculations. That's a point which we're trying to make here, irrespective of the method of valuation that you apply. Your company is ultimately worth what you and your investors agree it's worth. Let me give you a very simple example. Suppose you open up a restaurant today and you invest 1 crore of rupees in that restaurant, and 2 years down the line, you decided to sell off that particular restaurant, right? Assume that restaurant is operational, it's making a little bit of money, may be profitable or may not be profitable, right? And you wanted to sell that particular restaurant. Now you did whatever you could do to find a prospect, to find a buyer, and you are absolutely not able to find an appropriate buyer who can actually buy your restaurant or actually buy your business, right? Now, irrespective of whatever you think in your head, you apply DCF, you apply the book value, you apply the fair value method, any damn method of valuation that you apply to your restaurant, the point is there is no buyer on the table. The basic fundamental principle of valuation for any business is there a buyer? If there is no buyer, there's just no valuation exists, frankly speaking, right? So second point is, irrespective of whatever number that you arrive by applying any of the valuation methods, the real value is what is being offered on the table by a prospective buyer. Different value by different value. I'm sure you all would have heard about it, that if you give a valuation assignment of any particular business to 4 different valuers, maybe you give the assignments to PwC, second to Deloitte, third to EY, KPMG, and Grant Thornton. I'm pretty sure that nobody will give you an exact number of valuation. Everybody will come back to you with a range of valuation, and high likelihood that these valuations number will differ from each other. And that's where it brings the complexity while doing a valuation exercise. Majority of the startups do not have an historical information, and whatever information that we have, it's primarily related to future, which is completely uncertain, right? It is very, very difficult to realistically forecast what would be my top line, what would be my bottom line, how my cash flow is going to be reflected. The fact is, the bottom line is that over 90 to 95% of the projections submitted by companies, whether it's startup or mature companies, to their respective venture capital investors, they just don't meet, and that's a ground reality, right? So it becomes really difficult to arrive at a valuation number, considering the fact there is no history and considering the fact there is extreme level of uncertainty involved in forecasting the numbers. We all have heard about it. Valuation is a complicated mix of science and art. We call it art because there's a lot of judgment, estimates, judgment in respect of which valuation method we should be used. You're relying on forecast and so many other things. So it's a lot of art involved. We call it science. Yes, having applied a bit of art, you use a particular method and do certain mathematics in certain fashion. So that becomes a science. And trust me, it's a very, very complicated mix of science and an art. Initial traction and high margin, right? This is particularly, I'm talking about startup companies. If you have a good amount of traction and good amount of margin, there is a probability that you will get a better valuation versus a company whose traction is missing. Multiple methods. There are all kinds of methods. The internet is flooded with a lot of knowledge, a lot of gyan available all over the internet. So it's a valuer experience and his expertise over a period of time that would help him to figure out which valuation method is more reasonable and should be applied while valuing a particular company. Supply and demand. If a particular company comes out with a very, very innovative project or maybe a new technology, which is not existing currently in the market, definitely the venture capital investors would be willing to take a bet onto that and ready to pay a premium for it, and vice versa. Emerging industries and hot trends are trends like SaaS business models, space tech, climate tech, energy, renewable energy, robotics, and IoT. All of these, they are all emerging industries and emerging sectors, and they are always in a high demand for quite some time. As I mentioned earlier, there is no single universally accepted analytical methodology for investors. The valuation expert will always involve a number of valuation methods to arrive at the value of their companies. And that's the ground reality. No particular one method can be singly applied and you can actually arrive at value. Second point is the use of startup valuation method is dependent upon the stage of the business. Now, if it is a startup, it's a different set of valuation methods. If it's a mature company, which is typically looking for a private equity fund, you typically rely more on the market multiple method. So it all depends on which stage of the business you are. Okay, I'll cover this slide maybe later on. Before that, let me just jump on to the valuation methods, okay? You all have heard about it, Burkus method, cost to duplicate, and book value. And I won't spend time onto it. This is just to give you, a kind of a reflection on that these are some of the methods which you would find all over the internet, and it's very, very simple and easy to explain. Cost to duplicate is simply that, let's take an example that if a startup has completed 8 months of his business line and an investor wanted to use this particular method, cost to duplicate, he will simply add all the expenses. If there is any fixed assets has been purchased, he will add value of that. He will add the notional salary of the startup or the founders. The point is he will simply arrive at a number that how much time, how much cost it will take to duplicate this startup, right? And how much time it will take. And that's how you derive this value. And book value is again very simple. You simply pick up the asset side minus the liability sides. Again, it has its own challenges. It's not something which is practically been used in the startup industry. And the Burkus method is nothing but they simply assign a particular value to a particular criteria. For example, if your product has been launched, they will assign $500,000 for this particular aspect of the business. If there is a traction, they will add another $500,000. If the product is not launched, it is just in a prototype, they will add some value. And that's how, they add, they arrive at value of a particular startup. Again, it's not that practical, which is being used in the industry. Let me just talk about something which is practically being used in the industry. So one important is the VC method, the desired IRR. Now, as we all know, when a venture capital investor makes an investor, he's always expecting a particular IRR on the investment. Now, the IRR could be different from one VC to another, depending upon the kind of investment that he's making. If he's making an investment in a high-tech proposal, probably he's looking for an exponential growth. He might be looking for 10x or 20x or 30x kind of a number in the next 5 years. But if it's a plain vanilla private equity transaction, he might be happy with a 20% kind of an IRR. So it depends upon investor to investor and a deal to deal. But let me just switch on to an Excel sheet, and I want to show you practically how it really works, right? Okay, it's there in the slide itself. So let's take this example, the projected revenue in the year 5 of your startup, which is under valuation. Let's say it's a $5 million, and they are projecting a PAT of 10%. That brings a profit after tax number of 0.5 million. So we are just trying to do a valuation basis of VC method, which is also known as a desired IRR method, right? So that's the projection submitted by a founder to a VC investor. Now let's move on to the next point. Assume that an investor is making a projection today that in the year 5, these category of businesses or this particular industry typically are valued at a 14x of PE multiple, right? And this is again a very top level guesswork that 5 years down the line, this business will be able to attract a PE multiple of 14x. Now that brings the value of the company to $7 million, which is simply you multiply a PAT, which is 0.5 million, with a PE multiple of 14x, that comes to $7 million of number. Now that's the projected value of the business in year 5. Assume that your projected IRR from this particular investment is 10x. Now it could differ from VC to VC, as I mentioned earlier. Now you're basically what you're doing a backward calculations here, right? Now when you do a backward calculation, that's $7 million after 5 years, and I'm expecting a 10x of return. So my current, as of today, post-money valuation is $0.7 million, which is 7 million divided by 10. That's a simple calculation. And assuming that you are raising a fund of about $500,000, and that brings the pre-money valuation of $0.2 billion. And that's how you derive at a stake, which is 29%. It's a very, very simple calculation. Basically, what I'm trying to ascertain that what would be my rate of return, what would be my IRR if I invest in this particular company, and assuming that the numbers which has been projected by the founder is going to be achieved in year 5, right? So my IRR is 29%. Now, this is also a valuation method, and this is also a way where you cross-verify that if you use, let's say, any other method of valuation, maybe a DCF method or a market multiple method or any other method, right? even if we have arrived at a valuation figure with that particular number, you are going to cross check that with this kind of a valuation, what would be my IRR? If your IRR is not, making it is not up to your expectation, that valuation number, irrespective of whatever number and whatever technique that you have adopted, is not going to work for you. It has practically happened with me about a couple of months back, where I was talking to one of the VC. We submitted a projection for one particular company, and the projections was not very steep. I would say it's more realistic in nature, with like 20% kind of a growth rate year on year. And when the VC did the calculation of, he said, okay, I'm looking for 25% of IRR, year 1, year 2, year 3, and this is my projection, this is my projected multiples. He did the calculation backward, and he says, Tarun, I'm getting an IRR of 9%, right? Why should I invest in this company? And I haven't discounted your projections, right? Without discounting your projection, I'm getting a 9% of IRR, and we do not invest in any business which has the potential to generate this kind of an IRR. We're looking for those companies which has the potential to at least generate 30 to 40% of the IRR. This was a live example which I've recently encountered a couple of months back. We went back to the company and said, look, your projected numbers are not up to the expectation. You really need to go back and build your, revise and edit your financial model. Let's go back to the top line and bottom line numbers and resubmit it. So if they can't make the desired IRR, no valuation would really work in your favor. All right. Couple of things. It does not take into account the future dilution. Maybe there would be round 2, round 3, and round 4, or there may be no round. So this particular method does not take into account the future dilutions of your stake. As you can say, it's a very, very simple calculation and it's straightforward. The most important point here to be used, it is very, very practical. Almost every investor, whether it's an angel investor or a VC investor, would definitely do this calculation to check, right, that whatever valuation that the investor and the company has agreed, does it making sense for them to invest when it comes to generating an IRR? If it not, then they might not be in a position to make an investment. One challenge obviously is projecting a company revenue and a top line and a bottom line 5 years down the line. It's a very, very uncertain number. So no matter whatever multiple that you forecast, whatever IRR that comes with this method, if your top line and bottom line numbers is not meeting, then everything comes for a toss, right? So yes, this is very, very important calculation, which we all should do when we approach any particular VC. Okay, I'm coming back. Rule of thumb. Now, what is rule of thumb? Now, this is again a more practical approach to a valuation method. Majority of the VC investors and majority of the angel investors, it could be angel networks or family offices, when they do make an investment into any business, typically and generally, they're always looking for a significant minority stake into your business. Now, it's a very subjective term. What is significant minority stake? It could be anything between, let's say, starting from 10%, and it can go up to 20%, right? So at times, when you reach out to a VC investor with your startups, your startup may be an year old with a little traction or more traction. When nothing comes to your head, you can't work around on a DCF method. the VC method is simply not working out, market multiples are not available, and there's a lot of confusion, but you like the business and you want to make an investment. So you simply say, okay, I will take 16%, or maybe I will take 18%. Now, there is no science, there is no art here. It's a rule of thumb, right? People would simply pick up a significant minority stake and would go ahead with make an investment. Having said that, as I mentioned earlier, that even if you take a significant minority stake, you will still test that valuation number with your VC method. That if I make 16%, if I'm taking a 16% equity stake in this particular company, let's say for an investment of $500,000, how much IRR I would be able to make in 5 years down the line, assuming that this company will achieve the projected numbers as has been submitted by them. So you will definitely cross-check here. I'm sure you all, majority of you would have seen Shark Tank. You have this 4-5, HNIs sittings. Now, nobody is applying any method there. That's the ground reality and the practical part of it, right? Everybody say, मुझे कम से कम 10% तो चाहिए, मैं 10% से कम नहीं करूँगा, I will not be able to add value. Some people would say, I will take at least 20%. It all depends upon a lot of factors, a lot of experience of them making a lot of investments already, a lot of judgment, a lot of guesswork. There is no one fixed approach which these guys could actually apply. So it just happened. We also call it as a market insight, wherein you have been into the ecosystem, and every single day you have been interacting with the startup community, with the investor community. So this kind of a startup, typically what should be the valuation numbers. You really don't have to dig deep too much on the valuation techniques and on the valuation numbers. You simply, let me give you an example, that if we approach a VC investors who is a sector focused fund, focusing on to edtech businesses, right? Just taking an example. Now, this VC fund would have already done, number of investment, prior to you guys approaching them, right? They have been into the industry day and night. They have been only talking about edtech businesses. They have been talking about valuations around them. So there is a lot of intelligence which inbuilt, which is coming through their experiences, right? That how much value I should offer for a company like this, right? It's a 6 months old company or a 2 months old company. They have done a little bit of traction, or they may not have done a traction. So, it's just a market insight, right? And even if you're not sure about that, what possibly could be a valuation number, you talk to your fellow VC to make possibly maybe your competitor. You all have friends and colleagues in the market. Okay, यार वो उसका जो आपका वो कंपनी आपने इन्वेस्ट किया है उसका क्या वैल्यूएशन नंबर है, व्हाट डू यू थिंक क्या मार्केट मल्टीपल होना चाहिए, राइट? And that's how the information flow through the grapevine, and that's how these VC investors typically makes investments. So these are all practical part of it. They are not methods, whether it's a rule of thumb, whether it's market insight, or whether it's a VC method, which is a desired IRA. These are all practicalities, and we can connect and correlate with these practicalities with what we typically have seen in Shark India startup channel. So market multiples. So let me now switch on to an Excel sheet, and I will practically show you how it really works. But before that, we have been we all have been talking that उस company को 5x का PE मिला है, that particular company got a revenue multiple of 10x, right? We have been all hearing these terminologies, these talks, in our startup ecosystem. But the question is multiple hai kya? What is a multiple that exactly that we're talking about? A multiple is nothing but a ratio, okay, with two variables into it. One, the value of the company, and second is the financial or maybe a non-financial variable, right? That's a multiple. Let me give you an example. So there is a listed company which has a market cap of 100 crore. It's a market cap of 100 crore. But that particular company has a profit after tax of 10 crore. Now, when I ask somebody what is the PE multiple of this particular company, the PE multiple of this company is very simple to calculate. It is the market cap divided by the profit after tax, which is 100 divided by 10. So we call it, this company is currently trading at a PE multiple of 10x. Simple calculation here, right? Similarly, there are EV EBITDA multiples, price to revenue multiple, and there are many more ratios or the variables which can be connected with the valuation numbers. So let me just switch on to an Excel sheet and I will share practically. We'll touch upon a little bit of basics before we make it a little bit more complicated here. Okay, guys, can you see my Excel sheet? Anybody can confirm? Sorry, I'm just struggling with my. All right, I hope you can view my Excel sheet, and let me just try and zoom it further for you. I'll try to give you a very simple and an easy example. This is a company, it's a listed company, which can be very well compared to your startup company, right? Now, the revenue of this company is 80 crores. This company has an EBITDA of about 15%. That brings to a number of 12 crore. This company has a PAT, which is profit after tax, is about 5%. So that brings a 4 crores of number. So 80 crores of top line, 12 crores of EBITDA, and 4 crores of PAT. Now, this company has an active user base of about 1 lakh, and the number of applications which has been downloaded by the customer is about 1.4 lakh. So these are the actual real metrics of a company which is listed company. This company has got a number of shares outstanding about 10 lakh. EPS, which is earning per share, is simply PAT divided by the number of shares. The current market price per share is 300 rupees. That brings the market cap of about 30 crores. You simply multiply the current market price per share with the number of shares outstanding. The company has got a debt of about 1.8 crore, cash 1.21, net debt is 0.59 crore. And you arrive at an enterprise value. What is the enterprise value? Enterprise value is the market cap plus net debt. That is your enterprise value. Now, these numbers are available because it is a listed company. If it is not a listed company, probably you may not get the details about market cap, which is the value of this particular company. Now let's do and calculations. Let's let's arrive at some of the multiples. We call it PAT multiples or PE multiple, and the formula is simple: the current market price divided by EPS. So let me do a calculation for you. We simply go, and the current market price is 300. We divide it with the EPS, which is 40. Okay, so that's give me 7.5x of PE multiple for this particular company. Okay, let's do a second. EBITDA multiple. What is EBITDA multiple? EBITDA multiple is EV divided by EBITDA. That comes 2.5x. Let's do it for you here. The EBITDA is this. Sorry, enterprise value is 30 crore. Divide. What is the EBITDA? The EBITDA is 12 crore. So my EV EBITDA multiple for this particular company is 2.5x. Let's do a third calculation. Price to sales multiple, which is market cap divided by total sales. Let's do a calculation here. What is the market cap? The market cap is 30 crores divided by sales. Sales is 80 crores. So that gives you, sorry, I think I've done some mistake here. 30. Okay, there's a small mistake here. We do, let's say, correct number. Yes, so market cap divided by revenue. So it is less than 1 multiple. Let's do another one. Active user multiple. We simply divide market cap, which is nothing but an equity value of this particular company, divide by the active user base. So we say market cap, which is 30 crore, divide by number of active users, which is 1 lakh. Okay, I have to, because this number is in crore and this number is in lakh. So I mean, when you do the correct calculation, this is the number 3000x. That's the number you will get. Download multiples, market cap divided by number of downloads. That will come to market cap divided by number of downloads. Okay, so that gives you a 2143x. So the point which I'm trying to make is that these multiples are what? These are the ratio between two variables, and one of the variable is basically the value of the company. So if you look at one variable is CMP, which is a market price, or maybe the market cap or the equity value. Here you have an EV, enterprise value. In price to sales, you have a market cap. In active user multiple, again, you have a market cap. And in the fifth multiple that we have calculated, you again have a market cap, right? Now, what do we do? Once we have, calculated these multiples, we simply try and apply these numbers to our own startup company, right? So let's take an example that I am just assuming for the time being that this particular company, this particular listed company is a a good competitor and a comparable company to your startup, right? And if it is the case, what you would do, this company is being traded at 7.5x of PE multiple. If your company, your startup, let's say you've got a PAT of about, let's say 1 crore rupees, right? So you simply multiply 1 crore with 7.5x and the value of your company is 7.5 crore rupees. Very simple, very easy to understand. Of course, it has its own challenges. It appears to be very simple when it comes to calculations, but in reality, it is not, because there is a lot of research that would need to go in finding out a right comparable companies and doing a lot of data analysis. Because if you don't do an apple to apple comparison, you will end up doing a valuation exercise which is completely unrealistic and unconnected, with your startup. Similarly, take an example that this company is being currently traded at an EV/EBITDA multiple of 2.5x. So if you have, let's say your company is still to be profitable at a PAT level, but it is profitable at an EBITDA level. So you might like to apply this particular multiple to your startup, assuming your startup has an EBITDA of, let's say, again, let's say 80 lakh. So simply 80 lakh. It has to be higher, maybe let's say 3 crores. 3 crores into 2.5x, that makes to about 7.5 crores of valuation. Let's take an example that your company is yet to achieve profitability both at an EBITDA level and also at an PAT level, right? And you like to use a sales multiple, right? So you simply multiply your sales with this multiple. So, I mean, it is one of the simplest, easiest way of calculating and arriving at a valuation number, right? So if you have a company which is into the SaaS industry, running a software company offering a SaaS model, right? The first thing that you do is simply look for a comparable listed company so that you can collate these numbers which I have collated here. You arrive at a calculations and you apply these numbers with a little bit of discount and arrive at a valuation numbers. Sorry, 1 second, I see some chat here. Screen not visible. Guys, can you confirm if my Excel sheet is visible to you? It's not visible? Oh. Oh, bad luck. I was just explaining this sheet, and I don't know how many of the audience have actually been able to absorb the calculation that I was talking about. I guess I will have to move on, but let me quickly summarize this for the audience here. So what I have done is basically I have just collated the numbers of a listed company. I have collated the revenue, EBITDA, PAT, number of active users, number of downloads, number of outstanding shares, what is your EPS, what is the current market price, market cap. These are all the numbers which is available on several financial websites like moneycontrol.com, BSC, NSE, etc., etc. And once you have these numbers with you, you try and calculate the multiple. Now, as I mentioned earlier, multiple is nothing but a relationship and a link between the two numbers. So there is a PAT multiple, EBITDA multiple, price to sales multiple, active user multiple, and application download multiple. You simply arrive at that particular math and you apply this multiple to your startup. Is there any question that I can take right now? I really don't want to just keep talking and rushing from slide to slide. It's good to let me just pause here for about a minute or so. And if anybody has any confusion, any questions till now, I'm happy to discuss and talk about it a little bit more. So anybody from the institute is online right now? Can anybody hear me? Anybody from the institute hearing me? All right, I just get to know that I will need to continue. The participants may not be able to talk at this point in time, but let me just move on to the next slide quickly. So Kritik, we talk about VC method, which is the reverse calculation, wherein the venture capital investors is looking back and checking out that what kind of an IRR or what kind of a return that I would be making with this kind of a valuation that we have agreed and discussed. Second is the rule of thumb and market insight, which is nothing that majority of the VC investors typically take significant minority stake in the company, and market insight is nothing but a lot of market intelligence which is inbuilt into the system, and they are very well prepared and they are aware that what kind of a valuation multiple or what kind of a valuation number that they can afford to give to a particular startup. So they are well experienced in that sense. Fourth, we talk about the market multiples. We discussed about the multiples. Now, there are two ways wherein we can apply this multiples. One is a recent transaction, and second is a comparable transactions. Now, comparable transaction is basically, your competitors or another company in a similar line of business, precisely taking this precisely part of the same industry, predominantly doing same business, maybe selling a similar line of product, etc., etc. So the biggest challenge in this particular method is actually to find the right comparables for your company. And even if you find a right comparable, maybe you find a bigger company, maybe let's say you are a 2-year-old startup and you come across a company in the beverages sectors, which is maybe a giant of this industry, maybe a Coca-Cola or a Pepsi or any other beverages company. Now, dynamic of that particular company would be completely different from the dynamic of your company in terms of the growth rates, in terms of the margin, in terms of the product line, in terms of the growth that I'm talking about, the target customer, the target market, and there are many more factors. So if you simply try and arrive at a particular valuation multiple of that big company and simply do a calculation to arrive at the valuation of your startup, it will not be realistic, frankly speaking. There are a lot more intelligence that goes in analyzing the numbers. You really have to go in details about the entire financial metrics and the data that that particular company has in comparison to your startup, and make an appropriate adjustment, provide an appropriate liquidity discount to those multiples, and finally arrive at a valuation number. So the difference between recent transaction and comparable transaction is that both are multiples, right? The only difference is that in a comparable transaction, you look for companies which are similar to your business. And in case of a recent transaction, you try and look for any merger and acquisition transactions, right? So if any company which is pretty much similar in business like your have been sold, acquired, merged, right, in the last 6 months, year, or maybe 2 years, right? And if the valuation number of that particular transaction is being published or available from a reliable source, so that becomes your source number, that this particular transaction happened this many maybe 6 months back, and we relate our business with that particular company. So you try to obtain the same financial metrics which you typically would obtain in a comparable transactions, and that's how you apply those multiple to your valuation for a startup. So let me go back to the Excel sheet, and 1 second. Okay, we covered this. There are two main types of valuation multiple we just discussed practically in an Excel sheet. There are equity multiples, which primarily and largely dominated and used in the industry are PE multiples, or price to sales multiple. And then there are enterprise value multiples, which typically and largely used are EV to revenue and EV to EBITDA. And two methods which we just discussed before, the comparable company analysis and precedent transaction analysis. We discussed about it. Couple of points for market multiples. When we do a valuation using a market multiple approach, we are typically, it is the whole genesis, the concept is based that assets that are similar in nature will be sold at similar prices. That's the whole, crisp, and that's the whole thesis of this particular valuation method. कि अगर दो business same line में हैं, तो उनका price भी same होगा. That's the whole point which we are trying to make here. Now, when you do and calculate a multiple for your comparable transaction, it's very, very important that you figure out and you find your comparable companies, which should be at least 4 or 5, right? You just can't say, okay, that particular company is comparable to me. Let's take the multiples of that particular company. You will have to really, enlarge the depth of your research and find out more comparable companies, at least 4 or 5. Consolidate their multiples in one Excel sheet. Try to arrive at a mean or a median of those multiples, and then apply those multiples to your startup. As I said, that this is again widely used and easy to operate. Primarily, this particular method is being applied to more mature companies and largely in a private equity kind of a transactions, and also in those companies where there are comparables available, right? So take for an example that you are bringing some kind of an innovation or a technology product, and you just couldn't find any listed company in India or maybe outside which can be best resembles to your line of business, right? So you won't be able to apply a market multiple methods here. You will have to use and adopt other valuation methodologies for the same. It's a relative valuation method, right? Unlike a DCF method, which help you to derive at an intrinsic value, this valuation method gives you a relative valuation, in relation to another company. So that particular listed company is being valued at, let's say, 10x. So my company should be valued at least 8x or at least 7x. So it's a relative way of valuing your company. As I mentioned, that finding the right comparable is a big challenge. This is the most complicated part and the most difficult part when you use this particular valuation methodology, that you won't get an apple to apple comparison. Maybe you get a company which is in the same industry. Maybe you get a company in a similar line of business, but the other company could be producing a range of product. The margin of those products could be completely different. The target market could be completely different. The historical growth could be completely different. And there could be n number of financial and non-financial variables which could be completely different. And you may not be able to relate and connect with your company, right? So at the end of the day, when you use this particular method, what we are talking about, a lot of research, a lot of data points, and lot of estimates that you will have to apply to arrive at a valuation numbers, right? No single technique or no single method of valuation is good enough. Multiples reflect short-term rather than long-term values. Now this is the drawback in this particular method, that it does not take into account the future value that your startup can generate in 5 years down the line. It simply apply a market multiple of your comparable listed company and do the calculations. Important to choose the right multiple, as we talked about it. Apply liquidity discount to multiples. The liquidity discount is basically you are making a valuation of a private company, while the multiples that you are picking up, it's for a listed company. So you need to deduct or provide a liquidity discount. So on the one side, you are taking market multiple of a listed company, which effectively means it's a liquid investment. You can purchase and sell to the stock market at any point of time, unlike a private company where it is difficult to liquidate. So you have to provide a little bit of liquidity discount from the PE multiple that you have arrived from your listed market comparables. Evaluate companies using a variety of multiple. As I said, valuation is all about judgments, estimates, forecast, and there is no single way which can be applied. So you will have to apply multiple methods of valuation. You will do DCF, you will do market multiple, you will apply rule of thumb, you will check market insights, right? And when you apply market multiple, you will apply probably a multiple market, various market multiples, which means the PE multiples, also the EV/EBITDA multiple, and so on and so forth. The whole idea of doing a valuation exercise is actually to secure a range, the boundary. Okay, DCF करा तो क्या number आया? अगर हम market multiple करते हैं तो क्या number आ रहा है, right? If we do a VC method, which is a desired IRR, is it making sense, right? So you do that all calculation. You deep dive into those data base and financial numbers and see what is best suited for your company. If I could really summarize in one line, as I've repeated a couple of times, and I want to repeat it once more, that no single method is good to value any startup. You got to really apply multiple ways and multiple ways to arrive at a valuation number. Okay, so this is just a quick way how you typically do the valuation, right? So there are these 5 companies on the extreme left of the slide: the Coca-Cola Company, the PepsiCo, Dr. Pepper, Monster Beverages, and National Beverages. In the middle, we have collated these data because these are listed companies. So this data is available to you. So we picked up the market data, which is the market price, market cap, terminal enterprise value. And then there are financial data is also available: sales number, EBITDA number, EBIT number, and earning numbers. Now, what we have to do, we have to simply calculate the multiples. So they have collated 4 kinds of multiples here: EV to sales, EV to EBITDA, EV to EBIT, and a PE multiples. Now, in the second table next to it, this is, look at this number, the table number 2, the extreme right corner, these multiples have been calculated. Now, this is the multiple of not of your startup company, right? This is the multiple of the companies which is similar in business and listed on the stock exchange. Because they are listed, that is why we have the numbers of market price and market cap available. And if you have the number, you are able to calculate these PE multiples. And if you look at the last 2 lines, what we have done, we have calculated the average and also the median for each of the multiple. So for EV to sales, right, the Coca-Cola Company was trading at 4x, the PepsiCo was trading as 2.2x, the next one was trading as 2.1x, the next at 4.9, and the next at 1.5. So the average comes to about 2.9x and the median comes to about 2.2x. Similarly, you do the same calculation for rest of your multiple metrics. So as I said, this is just to give you a range. And what is the range? That EV to sales for a set of these companies is in the range of 2.2 to 2.9x. So anything between 2.5, 2.6 is a reasonable way to value a company in this particular sector. Similarly, if you look at the PE multiple, it gives you a range. Anything between 20 to 25 is a good PE number, and with this kind of a multiple, you would be in a position to actually do the valuation of your company. So this is how, when you do the financial modeling, the projections that you have built up, you will have to really include and add on this kind of a sheet where you incorporate a lot of data after a lot of research, and that's how you derive the market multiples. Okay, let me just quickly go back to the Excel sheet once again, and I want to show you something here. Okay, let me check if we have missed anything here. We covered this. Okay, DCF. Okay, all right. Discounted cash flow method, very old, one of the famous approach to do valuation of companies. Most of the chartered accountants, most of the advisors who have been advising a lot of startup companies, they have been using this method to value their company. Frankly speaking, while this is one of the methods which can be used, but this is simply and completely ignored by almost all VC investors. This is just a reference point. This is not the basis. You just cannot value a company basis a value arrived using a DCF method. What is a DCF method? It is nothing but a present value of a future cash flow over the next 4-5 years. That's what we are talking about here. Now, for a startup company who is just a year old or maybe a couple of years old, it is practically difficult and it would be unrealistic to predict the cash flow for the next 5 to 6 years with a reasonable amount of certainty, right? So the entire thesis of your valuation using this valuation method comes for a toss, because the numbers which becomes the basis of valuation is extremely uncertain, right? It's a very easy and simple way of calculating value under this method. There are tons of templates, the Excel templates available all over the internet, wherein you simply download the template, you fix or incorporate the numbers of your startup company, you add a discount rate, which is weighted average cost of capital, and you simply calculate the present value. It's very easy, but this is not practically being used. And I would recommend, I would encourage, and I would advise all my colleagues, my friends, to please not simply use this method, and as it is not going to make much difference in terms of the valuation. This valuation is generally and primarily used in those cases where there is a reasonable amount of certainty with respect to the future cash flow in the business. And if there is no certainty, the whole thesis of the valuation, collapse here. So look at this slide. This explain how do we calculate. So you simply this is your cash flow. You're generating $100 for the next 4 or 5 years. You're discounting those future cash flows to the present number, and you arrived at $565 million of value. Okay, this is a typical Excel template to do a calculation for under the DCF method. If you are looking one of these template, feel free to drop me an email. You have my email on the very first page of the slide and also on the last page of the slide. I would be happy to share this particular format. It's simply you are just calculating cash flow, which is the row number 19, and you are discounting that cash flow. We have assumed the discount rate here is 12%. You're discounting the cash flow, and that's how you are arriving at a valuation number. I don't want to get into the details of these numbers. It will get really complicated here, but it's very easy to understand. And I, being a chartered accountant, I'm sure you all understand this well. The only point which I'm trying to make here is that it's not a practical way to value your company. So please do not rely on this. If we have to do the valuation, use all possible and probable methods available to do the valuation of your company. All right, we talked about what is multiple. We talked about equity multiples, enterprise value multiples. We discussed about this. We discussed this. Convertible note. One of the way, these days, most of the angel investors and also the venture capitalists, they are making investments using convertible note as an instrument instead of taking direct equity into the business. Now, at times it becomes really difficult to arrive at the valuation of the company, or maybe if you arrive at a valuation of the company, there is a high level of conflict and difference in terms of the expectation of a founder and what probably and venture capitalists can give value to you. So there is a mismatch in terms of the aspiration of a founder versus what can be offered by a venture capital investor. So they issue a convertible note, which is primarily a debt instrument, which may or may not convert into an equity. And if it convert into an equity, which is dependent on the occurrence of specified event, and if that event happen, that convertible note can or will be converted into certain number of shares as per the terms and conditions agreed. So you are basically taking the benefits of a debt and also of an equity. Till the time it is not converted into an equity, it's a debt on the company with an option to convert. So it's a win-win situation as far as the investor is concerned. But from the perspective of a startup founder, it's not, because when you're making an investment, you are not taking equity. You are providing a debt with an option to convert. So it's not a very, very happy situation. Yes, this is one of the easiest and convenient way to raise money. When you're holding convertible notes, you do not have any control or voting power into the company. Investor may opt not to convert if the company is not doing well, and they have the option to convert if the company is doing well. So it's a win-win situation for the investor. Another instrument which is being used is the compulsorily convertible debenture. The only difference between convertible note and compulsory convertible debenture is that in case of CCD, which is compulsorily convertible debenture, you must convert your CCD into equity at certain point in time, versus a convertible note where you may or may not convert it. So from a valuation perspective, it's important to understand the financial instrument which is going to make a difference for you guys. Now, let me also caution you on one important instrument which is usually used by the VC investors, and typically in a large transaction, which is cumulative compulsory convertible preference share, which is CCCPS. Now, usually in large transactions, when an investor makes an investment, instead of taking a direct equity, because the moment you take a direct equity, you become part owner of that company to that extent, right? And if the company is not doing well in the future versus the representations or the projections submitted by the founder, you're going to be making a big losses, right? So what typically companies does that they take CCPS and they agree to convert at a later date, depending upon the performance of the company, which can be measured either from the top line or the bottom line. Now, let me show you an example which demonstrates how important it is for a founder or a business owner to ensure that they submit a realistic projections for their business. The financial plan that we are talking about, especially in a case when an investor decided to take CCCPS instead of taking a direct equity. So let me just switch on to my Excel sheet, and that gives you more clarity about it. Okay, so look at column A and B. This company has a PAT of about 3 crores with a PAT multiple of 7.5x. That brings a pre-money equity value of 19 crore, which is 7.5 into 3. The company is raising about 3 crores. So that brings the post-money valuation. Let me just zoom it for you. So the post-money valuation is about 22 crores. Stake offered to the investor is about 14%. So that's the the valuation of a company. The valuation of this company is 3 crores. The investor is taking about 14% equity stake into the company. Now this is a very simple and easy calculation. Now let's check out how the future turned out and how investors are ensuring that they do not end up making losses. At the end of the day, it's not the percentage stake which is important. It is the value in the company which is important, right? If you take, let's say, 60% stake in the company and the value of the company is negligible, what do you do with that 60%? So the focus should be on creation of a value rather than the percentage stake that you're taking into the company. So let me just unhide these numbers. So this is scenario 1, year 0, 1, 2, 3, 4, 5. This is the projection submitted by the founder to a VC investor. So you're saying you have a PAT of 3 crore, 6 crore, 13 crore, 18 crore, 50 crore, and 65 crore. You are assuming that the projected multiple will remain same. So you are entering into the company at 7.5x, and you are assuming the same multiple will follow. So neither there is no contraction in the multiple and there is no increase in the multiple. Now assume in year 4, the company actually achieved 50 crores of PAT. Applying a multiple of 7.5x, that brings the pre-money equity value to the company to about 375 crores. The company had initially taken 14% of stake. So the investors' value is about 52 crores. How much you had invested? You had invested 3 crores. Your 3 crores becomes 52 crores in year 4, right? So these were the projections and the company did well. The investor took 14% of equity stake, and as you can see, the investor is making huge amount of money from 3 crore to 52 crore. Now let's take scenario 2. Let me just unhide some of the rows here. Now scenario 2 is you had projected that in year 4, you will achieve 50 crores of number. Now, instead of 50 crores, your PAT is 12 crore. From 50 crore, you came down to 12 crore. Assuming the same multiple, which is 7.5x, your pre-money equity value is 19 crore. You had taken 14% of equity stake at the time of investment. So the value of your stake is only 12 crore. So from an investment of 3 crores, you have reached to 12 crores of number. Now in scenario 1, when everything goes well, you were making 52 crores of value. In scenario 2, when the company did not perform well, you arrive at 12 crores of value. Now it's a complete loss, right? The projections submitted by the founders and the business owners, they just did not reconcile. The reality hits hard and they couldn't achieve those numbers. Who is at loss? The investor. Now look at scenario number 3. In this scenario number 3, the investor says, I will not take equity at the time of investment in year 0. He's saying, I will not take equity. I will take CCCPS, compulsory convertible cumulative preference share, which will be convertible, which will get converted into an equity share at a later date, depending upon the performance of the company, right? So CCPS stands into the balance sheet. It's not equity shares. There is certain amount of dividend, attached to it. You're earning that amount of dividend until those preference shares get converted into equity shares. Now, the condition of the investor is, let's say your performance went down, which is 12 crore, okay, as according to scenario 2. Your multiples remain same, which is 7.5 crore. Your pre-money equity value is 90 crore. Now, in year 0, you had projected to your investors that the value of your stake will be 52 crores, because you had projected you will achieve 50 crores of top line, and that brings the 52 crores of value to your stake. Now, since the performance has gone down, the value, since your preference share did not get converted, so you agreed on a formula that I want 52 crores of value for my 3 crores rupees. So you do a reverse calculation here. Expected equity value of your stake is 50 crore. So 90 crore का total value है, और आप बोल रहे हो कि मेरे को तो 52 crore चाहिए, क्योंकि this is what you had initially projected for me. So that if you do a reverse calculation, 52 divided by 90, that brings the 57% stake. So your preference share will be converted into equity share in year 4, so as you end up securing a 57% stake into the company. And that's how you will make 52 crores of rupees. Now that's kind of a punishment to a founder, to a startup owner, because the projection that he had shown initially, it was 50 crores. And instead of 50 crore, you end up making only 12 crores of PAT. So that is how investors kind of protect themselves in such a manner that the actual percentage stake that you will take is not 14%, it will actually be 57%, right? So now, as you can see, that if you try to oversmart with an investor and show numbers or project numbers which are unrealistic, unachievable, it is going to backfire for sure, right? Nobody's going to take it on the face value, and investors has all kinds of financial instrument to put you into a trap. And at the end of the day, it's important that it's a win-win situation for both the parties. So I would never advise and encourage anybody to actually show hockey stick kind of a number. It doesn't make sense for anybody. So that's where we are. Let me go back to okay. So broadly, I covered. In summary, as I mentioned earlier, multiple method needs to be used. A lot of data needs to be collated. A lot of research needs to be done. There is no particular mathematical formula or a particular method which can be blindly applied and you arrive at a valuation number. No, it doesn't work practically, right? So one needs a lot of experience, a lot of judgment, and try to arrange at a range, that mera valuation company ka, it should be in the range of, let's say, 3 million to 5 million. That's a range, broad range, and that broad range comes from using different category of valuation methods. And now once you have a range, once you have a boundary line, you would be in a better position to negotiate with the investor. The only way you can negotiate with the investor if you have a data. If you don't have a data, there is no way you would be able to negotiate. So that's all from my end in this particular presentation. But let me just see. Okay, I have got a very large questions. Let me try and pick up the questions. Is any ideal standard set for a multiple for determining best or measuring startup result is? Okay, there are two questions. Is any ideal standard set for multiple? No, there is no ideal standard set. As I said, there are no formulas, there is no mathematical formation which is available. You will have to make a lot of research with respect to the companies and find your comparables. And should you use equity multiples? Should you use enterprise multiple? Should you use EV/EBITDA? Should you use price to sales? It all depends upon a lot of factors. So you will really have to dig deep. कि PE multiple use करना चाहिए या EV/EBITDA multiple use करना चाहिए या कुछ और multiple use करना चाहिए और क्यों करना चाहिए. And again, you should use multiple methods. That's how it is. Measuring startup result is good or excellent? Sorry, I couldn't understand this question, so I will have to skip this. Do you have a methodology to identify a comparable listed company? Once again, there is no methodology as such. The idea is to find out a company which is closest to your business, So if you're part of a beverages industry, ideally a company which is into a beverages industry. Now within the beverages, there are variations. Maybe someone is making juices while the other company is making cold drinks. Within the juices, somebody would be making fresh juices, somebody would be making packed juices. Another beverage company, they are purely focused on healthy beverages. So all kinds of companies are there. You will have to do an analysis that which company resembles me the most, right? And that's how you bring that company into analysis, collate the numbers of that company and few other companies. As I mentioned in my presentation, that just one company will not be enough. You will have to take at least 4 to 5 companies, right? That's how it is. Question number 3, how we can guide the clients to get maximum value for VC financing. With your vast startup valuation workers, what would be multiple X that can be given to cosmetic or apparel industry? Need ballpark, we are working on these industry, would be great if you can guide. Okay. So there are 2 parts to the question, how we can guide the clients to get maximum value for VC financing. There are no shortcuts, there are no tricks. The only way you can try to negotiate a better value if we have more data points, right? Now an analyst, an investment team member sitting in the venture capitalist, in the venture capital investor company, that's his job. Once he receive a proposal, he identify the comparables, he apply the DCF model, he check what is the IRR, he arrive at a range that what is the maximum valuation that we can offer, what is the minimum valuation that we can offer, what is my expected IRR, So you try and collate numbers, he will look at other companies where they have made an investment, at what valuation numbers that they had done the investors, Once they have a lot of data sets, and that's how they try and arrive at a valuation number. Exactly the same thing that you as an advisor or you as a startup owner will have to do. Find out if there are mergers and acquisitions in a similar transaction, in a similar kind of business. Is there any comparable companies that you can connect and relate with? This is where the DCF model is. This is where the IRR that investor would be able to generate. There are these 2-3 examples, which you can quote. You can connect with fellow founders, right, from your industry. Check with them. Hey, guys, what's the valuation of your company? How did your company was valued by your investor? So a lot of information from a grapevine, and obviously from valuation methodologies, and that's how you did. Again, it's a range of numbers. There's no fixed number. The second part to the question is cosmetic, and I don't know what valuation, which P multiple should be given to a cosmetic and apparel industry. We'll have to again look at the comparable set of companies in this particular sector, arrive at a valuation. That's the only way. Can you explain how to value hotel industry startups? We will get this presentation and Excel sheet. As far as the Excel sheet and presentation, please drop me an email. I will mail you the presentation and also the Excel template that I have. My email ID is I'll type it here, TARUN@pepartners.in. I promise to mail you the Excel sheet and also the presentation if I get a mail from you. All right. Question number. Okay. Can you explain how to value hotel industry startup? Again, please try to understand. Again and again, I am pointing out to one very, very important thing, and that is there is no one particular technique or a method which can be applied for the valuation of any company. आपको होटल इंडस्ट्री का वैल्यूएशन करना है, आप because there are fixed assets involved there, you do a book value. See what is the book value of it. You do a fair value of your hotel business. Second method. Third, you do a DCF method, find out the present value of the future cash flow. 4, you arrive at a market multiple for the hotel industry and apply that multiple to your company, right? What else? 5th, right? Expect that any investor who would make an investment would expect a minimum 20% IRR. If you do a reverse calculation, what would be the valuation of my hotel? So you have to do all that work. I can't just tell you, okay, aap ye kar lo aur aapka valuation final hoga. No, it's not going to happen that way. Practically, ऐसे ही होता है. Theoretically, हम लोग क्या करते हैं? Excel का template उठाया, DCF के numbers डाले और advisor पढ़ के बोलते हैं कि हमारा ये valuation numbers हो गया. No, it doesn't work that way. We are cloud computing company. There is none like us in India. How to compare? Now, when you don't find a comparable company in India, you will have to go one step up. Try to figure out a company outside the India stock exchange, US stock exchange, or many other stock exchanges. Now, again, that's a top line number. If you find a comparable company in a US stock exchange, please incorporate that, and it happens. I'm not telling you a theoretical perspective. It happens. I have done it. The notes that we have submitted to the investment committee for approval, we have done these calculations. We used to pick up companies which are listed in India. We also used to make a table for companies which is listed outside India, just to give you a perspective कि ये company की जो range है market multiples की, वो ये boundary है, between 6 multiple to 9.5 multiple, right? Now, it is not giving you a valuation of your company. It is only telling you that you have the ability to negotiate between these two lines. 6 से 9 के बीच का ये दायरा है, यहाँ पे negotiate कर लो. And obviously there are differences between those companies and your company, and accordingly you discount it on account of various parameters. So if you don't find a company listed in India, please go outside of India and get the numbers. It would be great if you can suggest affordable databases which can be used for transaction screening, company screening, and other startup. Now, there are lots of databases which are available, PitchBook hai, market intelligence hai. I guess if you just Google it, you will get to know. देखिए दो तरह से डेटा मिलता है. लिस्टेड कंपनी का तो इजी है, there are tons of website, BSE, money control, NSE, so that is not an issue. Now the challenge is to secure the financial information of a private limited company. If you have to secure the data of a private limited company, you go to the RSE, log in, make the payment, the amount of the fee, download the data, practically type those numbers into your Excel sheet, because very, very time consuming. So there are several companies in the market which gives you the financial information of private limited companies, but they may not be able to give you the valuation number. Why? If an investor has made an investment in convertible notes or in the form of a plain vanilla debt, how would you get to know the valuation of the equity? No, you can't. So that's a challenge. Data is a challenge here. I think one of the, I won't talk about the budget here, but which is a little off the topic, but I must add here that MSME is facing a very big challenge in the venture capital and private equity industry. Over 90% of the VC investors, they are all focused on tech and tech-enabled businesses. The plain vanilla traditional businesses is being completely ignored. Everybody is looking for a disruption. Everybody is looking for an innovation. Everybody is looking for emerging and hot sectors, this tech and that tech and so on and so forth. If you have a company or a client who is MSME, there are a high probability and high likelihood that you will not find a right set of investors for your company. And even if you find, there is a high probability that nobody would really entertain you. I have personally and practically read the investment thesis of almost every venture capital investor who is investing in India. And trust me, it's really, really difficult. If it's not a tech story, it's very difficult. What are all the options or remedies available for minority shareholders for listed software company case such a merger with a listed software company with a listed software company based on valuation? It's too long question whether the valuations can be changed by a court of law in case such minority shareholders. Oh God. Sorry, it's too complicated for me to answer. Frankly speaking, I'm not even able to understand the question. I really need to skip it. How to value a brand, how to value an IT company whose revenue has started. Now, traditionally, we all have studied in our accounting CA books that the value of a goodwill, the value of a brand is nothing but the valuation that you arrived minus the actual book value or maybe the fair value of the assets. So if the fair value of an asset is, let's say, $10 million, and you get a valuation, let's say a $25 million, you get 15 million extra, right? Why did you get 15 million extra? Because of, you may have a better foreseeable future. Now, this entire $15 million cannot be, translated in terms of the brand value or the goodwill value. But for startup companies, first of all, there is no brand, there is no goodwill, so there is no question of valuation of brand. But in bigger companies where the brand has actually established, that's the only formula which I just shared with you. The valuation of the company minus the fair value of the assets lying in that particular company, the difference is the brand value, and that's what we have studied and read in our CA books. What is a fair valuation multiple for a company in media? And see, I do not know why you don't need to ask to anybody or to me that what is the valuation multiple for a company in media, for a company in edtech, for a company in SaaS, for a company in manufacturing, for a company in government. No, I don't know. How would I get to know? Go out, check out the listed companies. It requires at least 2 to 3 days of research, and that's the only way you can arrive at a valuation number. Find out 4 or 5 different companies in the media and entertainment space who are listed. Collate those numbers as I've shown into the Excel sheet, and that's how you get to know that at what valuation and what P multiple or EV with a multiple these companies are getting traded. Okay, which is medium. Turnover 4.5 crore, net profit, monthly reach across. Again, same question, right? I don't have the answer that what is the valuation of your company, right? As I said, if you can do research, spend time on collating the data, it can give you some meaningful answers. Well, typically LLP is the question is, are VC also open to startup using structure like proprietorship LLP? Well, typically the LLP is their acceptable form of structure. Proprietorship is definitely not, and the ideal scenario is the private limited company. Can future potential non-financial, that is high adoption of technology of a startup, can give more weight than realistic value of startup extended? Yes, absolutely. If you're bringing a technology, it's an innovation, it's a disruption. Definitely, even if you may not have a revenue, you still get value of that disruption, that innovation, that technology that you're bringing on the table, right? Again, how to value this company is again a very $1 million question. How do you value? The same way which I have narrated. There are no other ways. Don't make valuation a complicated subject. वही simple फंडे हैं, बेसिक्स हैं, बिल्कुल वहीं तक आपको फोकस करना है और उसी में रिसर्च करनी है. कोई नई चीज नहीं है. स्टार्टअप वैल्यूएशन इज नॉट न्यू थिंग्स इन द मार्केट. वही चीजें हैं जो आपने सीए के एग्जाम्स में पढ़े हैं, बस उसको आपको सही तरीके से समझना है. समझना ये है कि देयर इज नो uniform valuation methodology which can be applied. 1. Second, you will have to apply multiple method. 3, the more you research, the better data points that you will have to justify your valuation. Valuation के 3 fundamental logical principles हैं. Okay, regarding unlisted companies, what kind of alternative valuation method can be adopted instead of market value that is not applicable? Sorry, I just missed the question. Methodology for, let me just go back. Oh, there are too many questions. I'm just going back to the question which I was reading. What kind of institute market value is there? What kind of alternative, shit, yeah, what is this? What kind of alternative valuation methods can be adopted instead of market value, as that is not applicable in these unlisted companies? We just talked about it. The alternative valuation method is the rule of thumb, the market insight, the VC method, the DCF method, right? You will have to use all of that data points and arrive at a range of valuation numbers. How deals structured as convertible notes, where a future conversion value is dependent upon next round of investment and the earlier investment is offered stake at a discount. Yes, I agree. As I mentioned in the presentation in the slide, that this particular, the VCC method, it does not take into account the future dilutions. Now, you are specifically talking about convertible notes. They typically agree on a formula that at such point in time, upon the occurrence of a particular event, this is how I will convert my convertible note into equity shares, right? So maybe just to give you an example, you agree that the next investors who brings equity into your company, right, and whatever valuation that the next round of investor agreed to, okay, I will agree my valuation at 20% discount to that. So if that equity investors give you $10 million of pre-money equity valuation, you will say, okay, I will assume my valuation is $8 million. That's how it works practically. CCPS can hold true only when the startup is cash earning. However, not a lot of startup cash earning. How CCPS will work in that case, even after the cash fund? CCPS is primarily used for more mature companies and in a typical private equity transactions of larger value. I have been practically part of 10 plus investment transactions, each in the range of $10 million. And in all those 10 companies, we have used CCPS as a financial instrument when making an investment. So I'm not saying for a startup you will use CCPS, but which instrument to be used again depends on a lot of factors. Would you use CCD? Would you use convertible notes? Would you use CCPS? Or should you use equity? There are 4-5 things, right? And again, it's very, very subjective. If it is a startup, you might like to use convertible notes because you're not able to arrive at a valuation number. Or if you're able to arrive at a valuation number and the startup is little mature, you might like to take a direct equity. And if it is not convertible note, you might like to choose CCD, which is compulsorily convertible debenture, and so on and so forth. So lot of factors which comes into play when you decide the financial instrument. Methodology for valuation of specialized skills in a field and to maximize value. I think I have already answered these questions. There are no other valuation methods besides what I have shared to you in the slide. And in every situation, you ideally should practically use all of these methods. Okay, so in case of CCPS, while the number issued is fixed, the liquidity that will convert to data is later date. Can you please share some of the resources that can be used to do research and collect data that can be used? All right, I will share my Excel sheet, as I mentioned, that gives you a little bit of perspective. And I'm sure if you Google it, you will get a lot of more material to it. Well, cost to duplicate approach, it's simple that how much money I will have to spend if I have to replicate this particular startup. Take for an example, you're working on a startup and it's been 8 months, right? And investors say that if I have to copy your startup, I might have to spend $1 million or $500,000, right? So it's a cost to duplicate approach. Well, Shark Tank, what Shark Tank people are following is rule of thumb and market insight. Nobody is doing a DCF calculation or a market multiple there, right? So it's the market insight, which is nothing but they have the information that how much stake that we should take. Typically, they look for significant minority stake, anything between 10 to 20%. And also a lot depends upon if you have already raised the money. So that also set a benchmark for you that this is the valuation at which we raised money earlier, and in a most in high likelihood that the follow-on money that comes into your company will ideally should come at a valuation which is better than this, assuming that your company is growing. So it's not a valuation method, but that also set a benchmark for you that I have raised my first round of money with X amount of valuation numbers, and that's how it works. All right, with that, I think time is 6 minutes over, and I am done with all the questions which has been written in the chat box. And thank you very much for taking out time in this chilly winter. And I really enjoyed talking to you. Hope to connect and meet you soon. Thank you very much.
Thank you to CA Chaurasia for deliberating on the startup valuation. And thank you to all the participants who are participating on this today's live webcast. And for all, happy National Startup Day. Thank you to all. With
Thank
this,
you very much.
we conclude this live webcast. Thank you to all.
Thank you, Dr. Sambit. Bye.